Hey everyone, welcome to the Stock Market for Beginners complete tutorial. In this video, we're going to be going through step by step, showing you exactly how to get started investing in the stock market. Now, unfortunately, this is not something that we can learn overnight, but we're going to dump as much information as we possibly can within this video. As you can probably tell, it's a pretty long video here that we're delivering today. So I do urge you to treat this like it was a class or like you're reading a book and you're really trying to consume as much information as possible. So I recommend taking out a piece of paper, taking out a pen. Feel free to pause throughout so you can write things down. I have a pretty large presentation that we're going to share with you on investing basics, and then we're going to get more in depth as we go on throughout the video. And we're going to try to keep this in an orderly fashion, but feel free to skip around. Maybe perhaps you already know some of these things, so you want to go to the parts that you're really interested in. I will leave timestamps down below in the description in this video so that you can skip around. And also feel free to check out some of the resources and links that we have for some of the different stock brokerages down in the description as well. So I am incredibly excited that you're getting started with your investing journey. And we've had a lot of people request a video like this where we go more in depth on actually how to invest into the stock market. And what I've seen is that people sometimes like to get the low-hanging fruit. They don't want to know how to invest in the stock market. They just want to know what to invest into. This is how most people tend to work. So the fact that you're here watching this video, learning how to actually do this rather than just listening to other people tell you what stocks to buy, I think this can really be a valuable asset that you can hold for many decades to come. So a couple of quick notes before we get really deep into this. One of them, be careful with scams. There's scammers everywhere impersonating me. They're going to like reach out to you. There's all kinds of stuff like that. We have nothing here to sell you. There's no course. There's no upsell. You don't have to worry about that. I know sometimes it's annoying when I'm halfway through a video and suddenly somebody says, if you want to know all the information, buy my online course or my book or something. There's none of that. You can learn everything about investing for totally free online or at your free local library. I'm a huge advocate for that. So don't feel like you have to pay somebody to learn how to do this. I never paid a single penny to anybody to learn how to invest, and I think it's been going pretty well. So one more thing that we need to note here is that I'm not a financial advisor. I'm just a guy on the internet sharing things that I've learned, things that I've done. But I'm by no means trying to be some type of stock guru to tell you that I'm the best investor of all time. There's nothing along those lines. I'm simply just a guy sharing some information, and hopefully you find some value in it. And if you do, make sure you drop a like on the video, subscribe to the channel so that you can see more videos like this. And let's get started with the first point when talking about the stock market and getting started with it. Okay, so I'm going to be going through this presentation. I found it was a lot better to do this rather than just have the full screen of me talking. I'm just going to be up in the corner here and run you through this presentation. And like I said, I really do hope you are taking some notes on this, or at least screenshotting or starting to remember some of these things that we discuss in this video. So one of the first things that we want to focus on is looking at risk and return and trying to increase that gap between risk and return. Now, what I mean by this is how do we mitigate risk? How do we lower risk as much as possible while increasing potential returns as much as possible? So if we can increase this gap, so we lower risk and we increase potential returns, that should be the focus. And sometimes I see people who maybe are going for high risk but low return investments. So you always want to be taking those two into consideration. How much risk is involved and how much potential reward is involved with any particular investment that we are thinking about making. Now, let's first just quickly go over some of the average stock market returns so that we can get a better understanding of where this type of investment might fall in comparison to maybe other types of investments like real estate or gold or cryptocurrency. And so the average stock market returns over the past 90 years for the S&P 500, we'll explain all of that later on exactly what that means, but it's been about 10% per year over the last 90 years. Now, this data can vary depending on which stocks you're looking at, but generally speaking, the overall stock market in the United States has grown about 10% per year. Now, this is not accounting for inflation, which can run anywhere between 2 and 3% per year on average. Now, this is very important to realize here that these are historical returns. This by no means is going to show you what's going to happen in the next 90 years. We really don't know. And we could see that the average stock market, if you take all stocks together and you combine them and you look at the average growth or the average decline, we really don't know where it's going to be in the future. But generally speaking, because society tends to move forward, we will probably see over a very long period of time, the stock market is likely to go up. But of course, nothing here is guaranteed. So you can see both these charts here. The green and red here is going to be the returns by year. So some years, the stock market might grow 30 or 40%. In other years, like what we saw in 2008, we saw the stock market decline about 40% in 1 year. So this was a pretty large decline, so it's going to fluctuate a lot. And what you'll learn with investing is that you do need to have some thick skin. When we say this, I mean that sometimes you want to be able to hold your investments through a lot of turbulent times. I have some friends who sold a lot of their investments at the peak of the pandemic last year in 2020 when it was April and their stocks were down 40 or 50% and they got scared and they sold. And now they look back a year later and they think, wow, I really probably should have just held through some of those turbulent times. So there's going to be a lot of turbulence. And the goal here, though, and what I'm going to be sharing with you in this video is how we can make sure that we're able to sleep well at night, because every night when I go to bed, I sleep pretty well. I'm not too worried, I'm not too stressed, and sometimes people will get too stressed over the stock market because they're over leveraged, or they're buying on margin, or they're doing something risky that maybe they shouldn't be doing. So we're always going to be focusing on mitigating that risk, but I wanted to show you these average stock market returns, and this is historically speaking, of course. Okay, now we want to talk about investing versus gambling. Now this kind of goes along with what we were just saying with when you're making investments. Our goal, my goal specifically, is to always focus on using logic rather than emotions when I'm making investment decisions. And the number one thing that I ask myself before any time that I make an investment is I say, Nate, am I investing or am I gambling? And this is always a question that I ask right before I click the buy button or the sell button. I ask myself, am I using logic or am I using my gut feeling? Am I going off of my instinct? Am I going off of what somebody told me, my friend sent me a DM and said, hey, make sure you buy this stock right now? So I'm always asking myself, am I making an investment or am I gambling? Because there is a massive difference between those two. And I really urge you to please catch yourself right now, especially if you're just getting started with investing, catch yourself and make sure that you're making logical decisions rather than ones based on emotion, where somebody says that maybe a stock's going to blow up and you're going to triple your money in 2 hours. Just be very, very careful with that. And also the dangers of following the crowd. I try not to follow the crowd as much as possible, because if everybody's flowing towards one opportunity, maybe perhaps we end up in a bubble. And this is what we saw with something like the dot-com bubble. It's a really fascinating bubble that happened in the late 90s, early 2000s, where essentially almost any company that put .com at the end of their name would suddenly see their stock double or triple in price in a matter of days, because everybody was super excited about the internet. But this brought upon a massive bubble where stocks were incredibly overvalued. And so we'll go more into that a little bit and talk about the dangers of bubbles and following the crowd in general. And that's just something that I wanted to share with you on how we can limit our emotions. The best way to do this is take our time. I don't like to make rash investment decisions. And of course, maybe throughout this video here, when we're talking about the markets, maybe you will disagree with something, and that's totally okay. Some of this is based off of my opinion, not following the crowd, I think can actually pay off pretty well. But, you don't have to take everything exactly literal from what I'm saying here. And I think you know where I'm going with that. Just to kind of show that I'm not a total professional. I'm not telling you that this is the specific way to invest. There's a lot of different strategies for investing, and people have succeeded with those. Okay, so now we're going to get into talking about what a stock is specifically. And I'm going to read this off here, and then we're going to go more in depth. So a stock represents ownership in a publicly traded company. So when you buy a company stock, you become a part owner of that company. So let's say that a company has 100 shares of stock. and you buy one of them, you now own 1% of that company. And this is one of my favorite things when you understand what a stock is. I remember the first time I learned what a stock was, I think it was a 6th grade or maybe a 7th grade project where we had to learn about the stock market. And once I learned that I could own a part of a billion-dollar company and I could have a stake in that, it was just one of the most exciting things that I realized that, I remember when I was in 6th grade or maybe it was 7th grade, it was 2009, and going around just saying, hey, I own a little tiny piece of Google. I own a very small fraction of Walmart or Waste Management or Coca-Cola. And this was just a really fun thing to be able to think about when I laid in bed at night thinking that I am a part owner in one of these companies. So that is essentially what a stock is. They are bought and sold on stock exchanges. And so we'll talk about some of the best stock brokers and the ways to buy this specifically. But it's pretty easy to buy and sell. Now, this is all based on supply and demand. So, if I have shares of stock and you want to buy shares of stock, then I can sell those shares to you and we can transact that way through a stock broker, which, like I said, we'll talk about more in the coming minutes. Now, we do need to understand why companies issue stock and what's the purpose of this. Why would this actually have to happen? And it's so that they can actually raise money. And so a company can raise money by issuing stock. Maybe you hear about IPOs. I know Coinbase just had their new listing and they raised a ton of money. A lot of money has flooded into Coinbase because of their IPO, and this happened with a lot of other companies as well. So why companies issue stock is so that they can raise money typically, but let's look at the difference between stocks and bonds. You probably hear people talking about bonds. They're not really very attractive right now in 2021. A lot of people don't really want bonds because they don't have a lot of payoff at the moment. That might change. It definitely did. It's totally different from what it was in the 80s or the 90s. But stocks versus bonds, with stocks, you actually own a piece of a company, so you're getting a share of the revenue. You're getting a share of the profit. You own part of that company. But with bonds, if you are buying bonds, you don't actually own that company. You're just lending money to that company, and then that company's paying you back with maybe a little bit of interest on top. So that's the difference between stocks and bonds. Hopefully I could clear that up. And if you have any questions along the way and you're a little bit confused, feel free to just leave some comments down below, and I'll try to respond to you if I can. Just watch out for all the scammers and in the comment section. There's a lot of them. You can also just send me a DM on Instagram and I'll do my best to respond to you, but sometimes I do get a little bit busy, so hopefully you can understand that. Okay, so now that we understand what a stock is, it's just a really tiny fraction of a company that you own. Now let's talk about how to buy stocks. There's a lot of different ways to buy stocks. If we look historically, we go way back in time. If you wanted to buy a stock, you would have to find a way to talk to the company and buy the stock. You'd have to go through a stock broker, maybe to your bank. We're talking way back like 100 years ago. It was not super easy to buy stocks. Then as we progressed through times, then we started to see where you have your stockbroker on the phone. And when you think of maybe a movie like The Wolf of Wall Street and people on the phone with their stockbroker, that's what happened for a pretty long period of time. If you wanted to buy stocks, you would call your stockbroker and they would make the transaction for you. They would buy it for you. They would sell it for you. Now we've moved into the digital age where starting really, I would say in the mid 2000s, we saw this big surge of stock brokerage firms online where you don't have to talk to a broker. You can just click a button, press a button on your phone, and you can buy or sell stocks extremely easily. All right, so let's talk about some of the best US brokerage firms, and then we'll talk about some of the best ones in Europe as well. Don't worry, I know I have a lot of European friends, so I'm not going to forget about you. Also Asia, Australia, Canada. It really does depend on what country you're in, and I don't know if I know all the best brokers in every country in the world, but I will give you some good ideas of ones that you can use to buy and sell stocks with. So if you are in the US, here are 3 ones that I would suggest using. You can pick from these 3. I'll leave links to each one of them down below so you can explore them and decide which one you want, or you could even open up multiple accounts and try them out and see which one you think really is the best platform to buy and sell stocks. The first one would be something like Robinhood. Not necessarily my favorite, but it's one of the most common, so I wanted to include it in this list. Then we have Public, very similar to Robinhood in a lot of ways, but they have a social feature onto it as well. So so you can see what I'm buying and selling on that app on public. And then M1 Finance is my other favorite investing app as well. And M1 Finance is really great for long-term investments, like if you're starting a Roth IRA and you want to have this for long-term investments, then M1 Finance is probably my go-to for that. So out of those three, which one would I personally prefer? This really depends on the promotions that they're offering. So sometimes they offer a free stock or some type of freebie. If they are, I will leave that link down below as well with some of the best features and some of the best options available to you at the moment. And I'm recording this video in 2021 here. I don't know. If things are going to change, I will link to the best broker out there because sometimes things happen with certain companies. They have problems. And so I will keep that updated as much as possible. Now, let's talk about if you are doing some passive investing and you want to invest in the stock market, but you don't want to think about what you're buying. You just want to kind of like set and forget and sort of do this passively. I would suggest using something like Wealthfront. So with Wealthfront, you're not actually buying and selling individual stocks. It's more so mutual funds and ETFs and long-term investments, and you're just telling them that you want to either be risky or not risky, and you can give them a couple of different options when you plan to retire, a couple of different options like that, and then Wealthfront can help invest your money for you. They take a really small fee, so I'll leave a link to them down below as well. They're a really great company. I've worked with them for a pretty long time, and so that's an option as well. Wealthfront for that passive long-term investing, and then the other three, Robinhood Public, M1 Finance, but there's also other options on top of that like Webull and some other ones as well that we're not going to have time to talk about in this video. So hopefully I can make a review of some of my favorite investing apps as well. If I remember to do that, then that would probably be pretty good for you. Now let's talk about the best international brokers. If you're outside of the United States, what should you be using? Here's the basic rundown. eToro, it's pretty nice. I like eToro, and it's available in a lot of countries. So I would suggest something like eToro if you are outside of the United States and you're looking to start investing. They also offer a lot of crypto investments as well in certain areas. So make sure you read into the fine print to see what's available, what's not available in your specific region or country. But eToro is pretty nice. Other options, if you're in the United Kingdom, something like Trading 212 seems to be a great one. In Canada, we see a lot of people using Questrade. If you are in Australia, there's some great ones as well that I will link to. And there are some other ones on top of that like DeGiro and Revolut and a couple of others in Europe as well. So I will, you know what? I'm going to make another video for European investing apps as well and for some of the other ones globally, because I know this is one of the most common questions that I get, and you could probably fix this by doing a Google search, but I promise you at some point this month I'm going to make a video just for all of my international friends who are looking to invest and what brokerage firm that they should use to start investing with. If you don't see it down in the description below. So that's what we're going to do for that. So those are the best brokers that you can use. Now, let's talk about the types of brokerage accounts. We have individual accounts, we have joint accounts, we have retirement accounts like IRA accounts, and then we have custodial accounts. So an individual account is probably the simplest account. It's the one if you just want to buy and sell stocks, you can do that through an individual account. It's pretty straightforward. Then we have joint accounts. A joint account is, let's say that you have a spouse and you want to make an account together with somebody, then you can do that through a joint account. Now we have retirement accounts like IRAs. If you're going to sign up for an IRA and you want to put some money aside for retirement, I would suggest using M1 Finance or Wealthfront. I'll leave links to both of those down below as well. But those are both great companies for setting up some type of IRA or a Roth IRA. We do have videos on those specifically as well. If you're confused about what an IRA is, it's an individual retirement account. I do suggest having one of them, although, of course, I'm not a financial advisor. I'm just a guy on the internet. And then we have custodial accounts, which is also a great option for people who are under the age of 18, because if you're not over 18, you're not going to be, or sorry, let me correct that. If you are under the age of 18, then you can't sign up for these brokerage accounts like Robinhood or Public. You can't sign up for them on your own. You're going to actually have to have somebody who is 18 or older sign up for them and create a custodial account with you. This is how I started investing at a younger age because I talked to my parents and they were They didn't really have a lot of understanding about what the stock market was, but I learned about it in school. I thought it was really interesting. I was a weird kid. I don't know. I just was like a bookworm. And so I was interested in it. And I had them help set up an account. So technically, it was my father who was on the account. And so this is not legal advice. I can't tell you if you are under the age of 18, you're going to have your parents do it for you, but you can consult with them and maybe talk with them, and they can make the transactions and trades for you. That's what I did when I was younger. So those are the different types of brokerage accounts. If you're outside the US, you might see some different options as well. I don't know if I can help you with that because I don't know the specific laws in your country. They certainly do differ depending on where you are. Okay. Now let's talk about investing strategies. There are 4 primary investing strategies out there at the moment. And some people will argue that there's really only 3, but I like to include 4 here to give a better understanding and analysis of each one of these. So we have fundamental analysis, technical analysis, behavioral, and then we have dollar cost averaging. And each one of these has pros and cons to it, and we'll go over each one of these so that you can decide the type of investor that you want to be. This is a very important question. You want to ask, what type of investor do I want to be? What are my goals? Do I want short-term growth? Do I want to become a millionaire overnight? Probably extremely unlikely. Or am I looking for long-term growth, maybe 10, 20, 30 years, so that I'm set for retirement and my family's set when I'm older and I don't have to worry about how to pay my bills? So you want to think about your investment strategy, and you can learn more about this maybe through a number of books that we'll share later in this video as well. But let's talk about the first one, which is the most common, which is using fundamental analysis. This is also commonly used for value investors. And when I think of value investors or fundamental analysis, I think of Warren Buffett, which is this guy right over here. I think he's almost in his 90s by now. He is a little bit old, but he is one of the best value investors of all time, and he uses fundamental analysis in order to determine if a stock is undervalued or overvalued. And this is the whole goal of investing. We're looking for investments that perhaps other people have overlooked. And we're looking for companies to invest into. We're looking for stocks to invest into that are undervalued. So we're comparing their true value and we're looking at their true value of what we believe it should be by looking at the fundamentals, by looking at the balance sheet, the income statement, the cash flow statement. We're looking at the fundamentals of a company and the health of that company, and we're determining whether or not the stock is undervalued or overvalued, and there is a vast array of ways that we can make this determination, but this is going to be the primary focus in this video. We like to use fundamental analysis. I would suggest it, or at least understanding how to do fundamental analysis on companies, because this is going to be how you are determining whether a company is healthy or not. I sort of use a lot of these different ratios and financial metrics. It's similar to if you're going to the doctor and they're going to take your heart rate, they're going to take your blood pressure, they're going to look at your temperature, they're going to take a look at some of those important vitals. That's similar to what we do with fundamental analysis. We're looking at what's the blood pressure of a company, what's the temperature of a company. So we're examining the health of the company, and that's just a little analogy, hopefully, to help you understand that a little bit. But it generally is for long-term outlook, and that's what we use fundamental analysis for, especially when we're doing value investing. And so that's going to be the one that we're talking about in this video, which we will really delve into in the latter half. Now, there's another strategy, and it's known as technical analysis. Now, technical analysis is typically what you might associate with when you think of a stock trader, when you think of somebody who has 5 big monitors and they have charts everywhere and they have the bars with red and green, and you see that they're trading stocks. Sometimes penny stocks, sometimes they're doing a lot of swing trading, but generally speaking, when we use technical analysis, it tends to be when people are looking to make short-term trades rather than long-term investments. And this isn't always the case, but it tends to be what we see. I would still definitely recommend learning about technical analysis because it can help you get into certain investments at certain times. So I do look at the technicals of stocks and I look at the charts to see when would be a good time to enter into that particular position or that particular stock. But generally speaking, I don't spend a lot of time with technical analysis because I'm more so focused on those long-term investments. And with technical analysis, it can take up a lot of your time. If you are a day trader or a swing trader, I don't have anything against this, and I honestly have a lot of friends who make money doing day trading, but there's a couple of problems that I see with it. And the biggest one is that it tends to take up a lot of time. You can't just sleep and have your investments grow. You have to be analyzing these charts and paying very close attention. So it's not really my cup of tea, but if it's yours, then that's totally great. Just watch out for a lot of the people selling their technical analysis, stock trading courses online somewhere. You don't need to do that. You can just pick up some books or watch some free videos on how to understand stock charts more specifically. Okay, so now let's talk about behavioral analysis and using social signals. This is my favorite way to determine whether a stock is something that I should buy or if it's something that I should sell. In behavioral analysis, it's relatively new, but what we're doing here is we're looking at human psychology, and we're thinking about groupthink within financial markets. So there is so much cognitive bias that happens within the markets. And so what we're doing here is we're making the assumption that there's a lot of irrational actors. Maybe we think that the market is not totally going to be efficient and that not everything's priced in, but maybe people act in fear. This certainly does happen. Look at a lot of market crashes in the past. We've seen stocks go down 80 or 90% because people were scared for no other reason for the fact that humans are very emotional creatures, and we can end up making money if we are able to understand and really disassociate from logic and from emotion, and we're able to separate those two. This is what a lot of behavioral analysis can really help with. And I'll give an example about a stock that I invested into using social signals was a company, Spirit Airlines, which a lot of people make fun of the airline because it's a very budget airline. But I bought this back in October, and it's more than doubled since then. Now, sure, I've made some bad investments as well, but I used a lot of social signals and behavioral analysis to make this investment and make the decision that this was going to be a good investment for me to make. And so for social signals, we'll actually talk about this when we get into the how to find winning stocks segment. That should be maybe in 20 minutes or so on exactly how we use those social signals. Now we also have the fourth strategy for investing, which is known as dollar cost averaging. And this really does have some upsides, a couple of small downsides, but it's one that I think most people tend to actually use when they invest in the stock market. Now, dollar cost averaging, you are neutralizing the short-term volatility by putting money into the markets or maybe into one particular stock, but usually into large amounts of groups of stocks like index funds or mutual funds or ETFs. And people do this, they put money in maybe once a month or every couple of weeks, but they do this periodically so that they can sort of level out where they're putting money into the markets. So the great thing about dollar cost averaging is, let's say that if you are dollar cost averaging, you're putting money into the markets, say once per month, you're taking your paycheck and you're putting it into the stock market once per month. Well, maybe if there was a huge, it was at the top and you were doing this and it comes down, well, you were still putting money in all along this whole time. Now, if you weren't doing dollar cost averaging, let's say that you had $1 million, you just inherited $1 million, that's great, isn't it? Let's say that you take that $1 million and you don't dollar cost average, you just dump it into the stock market on one day. And that one day happens to be in August of 1929. And then for the next 3 years, you watch that $1 million turn into $80,000 because you put it in at the wrong time. So dollar cost averaging helps smooth things out. That's why a lot of people do like it. And I would say the best thing about this is that it tends to be a pretty passive investment, meaning that you'll probably sleep pretty well at night, knowing that over a long period of time, the markets tend to increase over a very long period of time. That's not a promise, though. Just remember, that's not a promise. Anything could happen with the markets. And there's a common saying that time in the market beats timing the market. And so this is one of my favorite quotes as well to remember, and how difficult it is to really time the market. The only downside, though, of doing this dollar cost averaging passive investment strategy is you might miss out on some buying opportunities. I remember back in March of 2020, if I was just doing dollar cost averaging, I would not be putting very much money in when the markets had just crashed 40%. I saw a lot of deals that I could invest into. And so if I was just doing the dollar cost averaging, I would be conservative and I would only put in a couple $1,000s. But instead, I thought this was a little bit of an opportunity, so I dumped in a lot of money. It turned out that it worked out pretty well for me. So that is one of the only downsides there, is that you might miss out on some of those opportunities when you see stocks maybe dropped a lot and people are panicking and you're running towards that. Another one of my favorite quotes from Warren Buffett is to be fearful when others are greedy and greedy when others are fearful. So when everybody's running away, when everybody's panicking, this might be a buying opportunity. Not always, but it might be. So you want to make sure you do your research on that. So those are the 4 different strategies for investing. We have fundamental analysis, technical analysis, behavioral analysis, and dollar cost averaging. Hopefully you wrote down those 4 because maybe you want to use a collection of these 4. I actually use a collection of these 4 all the time, and I would suggest learning about each one of these and maybe using each one of them when you make investment decisions. Now, let's talk about active investing versus passive investing. We just introduced dollar cost averaging, so let's talk about the benefits and the downsides of each one of these. Now, first of all, we have active investing, and this is a strategy that I use for most of my money. This is conducting research, this is identifying risks, and you're trying to beat the stock market. You think that you are better than the stock market, or that you're maybe capable of finding better investments rather than just dumping your money into a big index fund that kind of tracks the overall stock market. So that's active investing. The problems with active investing, it takes up a lot of time. I spend at least 10 to 20 hours per week looking at the stocks that I own and making sure that everything's running smoothly, reading a lot of their financial statements, looking at the news for those companies so that I can make decisions and steer my ship of money, which isn't that big, but so maybe my small boat of money, and I'm trying to steer it in the right way. And with active investing, it might be a problem because you might have rocks everywhere and you're trying to navigate with your little boat, trying to make sure that you manage your money properly. So it could be pretty risky. You might end up losing a lot of money if you do active investing, but over time, I think you really do learn a lot, and you could potentially beat the stock market. Now, passive investing, you're probably using some type of dollar cost averaging. This is typically into diverse asset classes and funds to mitigate risk. So you can put them into index funds or mutual funds or ETFs. And this might contain 500 different stocks or 1,000 different stocks or 2, 3, 4,000 different stocks that you are putting your money into, and it kind of spreads out among all of those different stocks. And the reason why people do this is because if you are dollar cost averaging passively into a lot of different companies, it's seen as a pretty safe investment. Because let's say that one of the 500 companies that you invest into, let's say that one company goes bankrupt. Well, you have the other 499 companies to maybe continue the upward trend, or at least kind of stay in business. So that's kind of the whole idea versus active investing, where maybe you only have 5 different stocks. One of those companies goes bankrupt. Maybe your investment portfolio just dropped 20 or 30% because you were too heavy into one specific company. Okay, so these are the 3 major indexes in the United States. We have the Dow Jones Industrial Average, we have the S&P 500 Index, and we have the NASDAQ. These are 3 terms that I'm sure you've heard at some point in your life, people throwing them around saying that the markets are down 300 points today, or the S&P dropped 4% today. And so if you've heard these terms, people talking about this, whether you're just walking down the street and you hear somebody say this, or you're at Thanksgiving dinner, Christmas dinner, and somebody's rambling about how the markets are up 1,000 points or something is down, that's generally what they're going to be referring to, is probably one of these 3 indexes. Now, these indexes are great for using as a reference point for how the overall stock market is performing. So the first one here is the Dow Jones. Now, this contains about 30 companies. These are very large corporations in the United States. A lot of these are referred to as blue chip stocks. So it's a lot of companies that you are probably familiar with. And if you want to know the exact companies inside of the Dow Jones, you can just do a quick Google search to see what companies are inside of it. But the Dow Jones, it's not actually one stock. It's not one company. It's just a way of measuring how overall the stock market is doing. So it's not actually a thing. It's just almost like a thing of your imagination. It's just a way of measuring. It's a way of tracking how well stocks are doing. And so then we have the S&P 500 index, which is made up of 500 500 companies in the US. These are also very large companies in the US. I know Tesla was just added to the S&P 500, so we have a lot of different companies within this, but this is probably going to be the best way of gauging how the stock market is performing. So if somebody was going to ask me, how have stocks been over the past year? I would use the S&P 500 index as a reference, and I would say, well, if the S&P 500 index was up 20% last year, then it's kind of safe to say that the overall stock market was probably up about 20% last year. So it's probably one of the best ways of measuring how the US stock market is performing on a day-to-day basis and over a long period of time as well. Now we have the NASDAQ. The NASDAQ is it's generally going to be in a lot of technology, in IT. So you're going to see a lot of companies like Apple or Google in the NASDAQ. And the NASDAQ was really, really big back in the dot-com bubble in the late 90s, early 2000s when all these companies were something.com. We had Yahoo. So think of the NASDAQ. When you think of that, you're probably going to be associating that with a lot of tech companies, a lot of internet companies or software companies are probably going to be in the NASDAQ. But it's a great way to measure how tech is performing as well in the stock market. All right, so let's take a look at the 11 major sectors in the stock market. I recommend really focusing on a couple of sectors, and we will talk about how to find stocks, specifically how to find great companies. But what I would do, you have 11 different primary sectors in the stock market. I would focus on the ones that maybe you already have a pretty good understanding of. Maybe you have a lot of hobbies in something like financials. You're already really interested in real estate perhaps, or telecommunication, IT, real estate, right? We have all these different ones here. We have energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, telecommunication services, utilities, and real estate. So I would suggest kind of focusing on a couple of these 11. Don't try to become a jack of all trades and understand every single thing that's happening within the US economy. It's going to be really difficult to do that. So for me, I tend to focus on just a couple of them. So when you look at something like energy, people might be thinking that this is probably a lot of solar companies or windmills, but actually a lot of energy is going to be typical companies like ExxonMobil and British Petroleum and Shell. And so all of these are going to be very diverse, but every industry is going to have a different set of standards when it comes to what is a good or bad financial ratio or metric, which is the next segment here when we talk about how to actually find good stocks and winning stocks. Okay, now I want to just briefly talk about mutual funds versus ETFs versus index funds. What's the difference? The good thing is that if you accidentally use one of these three terms interchangeably, it's not going to be the end of the world. They are very similar, but there are still some differences that you want to be aware of. Now, mutual funds tend to be actively managed. They tend to have a little bit higher fees than something like an exchange-traded fund, which is what ETF stands for. And I really don't put a lot of money into mutual funds. They're also not updated until the end of the day, whereas an exchange-traded fund is going to be updated at any given moment simultaneously. So it's going to be always updating throughout the day as certain ETFs are bought and sold. So an ETF generally does like to track index funds. So you can buy an ETF of something like the S&P 500. You can buy an ETF of the Dow, or you can buy an ETF of the NASDAQ. So it's a great way to invest into the overall stock market. If you wanted to say, you know what, I want to invest my money into the S&P 500, which is going to hold a lot of different stocks because I want to play it safe. Maybe I want to do this passively. I don't want to have to think about what I'm doing with my money. And then you put it into an S&P 500 index, which is going to be an exchange-traded fund. And so you can do this. It has pretty low fees. One ticker for that, just for an example here, would be VOO. So if you just typed in VOO into your stock brokerage app, you'd be able to find this index fund, which is going to be an ETF that would be in that category. So hopefully I didn't just make that more confusing to you. But exchange-traded funds tend to be the ones that I like to invest into. Mutual funds, you're going to have a little bit more money, a little bit higher of a barrier of entry to them. Sometimes you need $1,000 or $3,000 $50,000 in order to buy into a mutual fund. So overall, I do prefer to have ETFs, which are also very similar to index funds, although you could have mutual funds that also are going to mimic index funds. Hopefully I'm not making that more confusing to you. If I am, feel free to just do a quick Google search on mutual funds versus ETFs. Now, let's talk about how to find winning stocks. This is going to be getting really into the details here. We're going to talk about a lot of different financial metrics, ratios, income statements, balance sheets. It's going to get really detailed. So I do urge you, make sure you are writing this down or pausing so that you can really let this marinate and think about as we go through this video. Now, how do we find winning stocks? This is my perspective. This is how I find winning stocks. People are going to have different strategies. Somebody might tell you to do something completely different, and that's okay. So this is not a prescription for you. This is simply what I do because I'm not a financial advisor, which I already said a couple of times throughout this video. Now, how do I find winning stocks? I like to focus on what I already know, things that I already understand. And I think this is a great starting point for anybody getting into investing. So what I think you should do is I would take out a pen, take out a piece of paper, and write down 5 of your hobbies or 5 of the things that you feel like you might have more knowledge than the average person about. Maybe you are really a car person and you love cars, you understand them very well, you understand everything about the car market. Maybe write that down as one of your strengths, something that you might know more than the average person about. If I had to do this, back when I started investing, one of the things that I started to look at was a lot of agricultural companies. Because believe it or not, I did a lot of agricultural stuff and I was into farming and I understood a lot of the different ag companies that were out there. And so because I had somewhat superior knowledge on that industry, that was one of my strongholds. And you can actually, make this for yourself if you don't know, if you're sitting there thinking that you have no knowledge about any industry or any sector, you don't have any hobbies, you're not good at anything, which I'm sure you are, trust me, you are. But if you're sitting there thinking that you're not good at anything, then go ahead and just pick a couple of different categories. Say, I'm going to learn a lot about amusement parks, or I'm going to learn a lot about the soft drink industry, or I'm going to learn a lot about the camera industry. And so you can start to learn more about those. But focus on what you know and focus on specific industries, specific topics, so that you're not trying to just be a jack of all trades. Because if you're trying to be a jack of all trades and you're going over here and you're looking at the swimming pool industry, and then you're looking at home builders, and then you're looking over at some new technology companies, and then you're looking at crypto companies, you're going to be all over the place. I try not to do that. Try to focus on what you know, but also I always do my best to try to block outside voices or hype. Look, if you're on Discord forums, you're on TikTok, and you're getting your stock investment advice from TikToks, be careful with that because a lot of people have agendas. And even if you are Googling a company, let's say that you're thinking about investing into Coca-Cola stock. And so you Google Coca-Cola stock, and maybe you find an article about Coca-Cola stock, and it says, this stock is definitely a great company, you should buy it, blah, 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 here's why I'm buying it. Okay, it's good to read that and to understand their points, but remember, everybody probably has an agenda. And maybe that person who wrote that article about how great Coca-Cola stock is, maybe that person has a large amount of Coca-Cola stock and they want the price to go up. So just remember, everybody might have an agenda for themselves. And so focus on yourself and your money when you're making investments and try to block out as many outside voices as possible when you are making investment decisions. That's going to be a very important step because if you're just following everybody, you can end up at the top of a bubble. Like if you're buying, Tesla at thousands of dollars, and maybe perhaps it's in a bubble, I don't know if it is, then you can end up losing a ton of money because everybody's hyped up and everybody's excited about it, and you're following the crowd, following the herd. Now, this is how I find winning stocks. I focus on macro trends, and then I focus on the micro afterwards. So look at macro trends. This is how I found a company like Spirit Airlines back in the fall. Back when COVID was still raging and we had no vaccine, there were a lot of problems. Airline stocks were down a lot from what they were in the previous year. And so I was looking at the trends of the airline industry as a whole, And so I was looking at the macro trends. I was looking at the big picture. When we say macro versus micro, macro means big picture, right? So think of macroeconomics. It's going to be the whole economy. It's going to be large industries. And then micro is looking, under like a microscope. It's looking at the very specifics of maybe certain specific companies. And so identifying macro trends, one of them was, hey, you know what? It's the fall of 2020. When I had this thought, I thought, you know what? I think airlines have a really bright future. There's going to be a ton of pent-up demand for airlines in next year because people couldn't fly in 2020. A lot of problems with the pandemic, obviously. And so I was looking at a macro trend. I was saying the airline industry is going to see a massive increase in people who are wanting to fly. So once I identified that macro trend, I then said, now I need to look at the micro. So I know the airline industry is probably primed. It's going to be doing well in a couple of years. So let me now look at the micro and find 5 different companies in the airline industry and analyze each one of those 5 companies. And so this is called a top-down strategy where you start with macro, then you get into the specific companies. You can also do a bottom-up strategy. This is not really as common, but maybe you are analyzing one company. Let's say that you start with one company, like you find Peloton stock, and you're interested in buying Peloton stock, and you then start with that, you analyze that company, you think, it has really good fundamentals, then you can branch out and look at its competitors. You can look at the industry as a whole. So you can start micro and go macro, although I would prefer to start macro and then go micro. Hopefully that's not confusing you there, but that is how I find winning stocks. That's how I identify 3 to 5 companies within any specific industry that I might be interested in. And from those 3 to 5 companies, I'm going to do a deep dive. I'm talking many hours per company that I'm spending reading all of their financials, analyzing the company, and then from those 3 to 5 companies, I'm probably only going to invest into 1 to 2 of those companies, and sometimes none of those companies, but generally 1 to 2 of those companies out of the 3 to 5 that I will pick to analyze in a specific industry. So that's one of the ways that I would suggest finding winning stocks. But how do we actually gather information? How do we analyze this company? And that's what we're going into at this moment here. So first thing we're doing, we're blocking out analyst reports. Like I mentioned in the previous slide, blocking out analyst reports, they usually have an agenda. They're usually hired by somebody. I see this all the time where there's an analyst who says that, this stock is definitely going to go up 20 or 30% by next quarter. And then you start to dig into it and you realize that, that person who's writing the article has some type of connection with somebody at that company. And it's all just kind of a big fraud in my opinion. So I wouldn't put too much weight on analyst reports. You can certainly read them because they might have some information that might be useful for if you're going to buy or sell a stock. But try to block out some of that, or at least not take it too literally. Now, also, where can you get information from? You can get it from your brokerage research features. So if you're using Robinhood, you're using Public, you're using TD Ameritrade, or any brokerage firm that you're using, this is a great way to just find stocks, look at their charts, look at some of the basics, and maybe find some of their financials on those. But it's not the best way to find stocks using your brokerage research tab that you might have available to you. By far, the best place to find information regarding a stock and a company as a whole is going to be their investor relations page. So I will go over an example of a company. So, let's just look at Spirit Airlines, for example. We will look at their investor relations page and we'll delve into it. This is the best way for you to find information. The easiest way to do this is just type into Google the company that you're thinking about, followed by investor relations. So what we'll do is just type in Spirit Airlines investor relations, and then we will probably be able to find their investor relations page. On this, they're going to have annual reports, which is also known as a Form 10K. They're also going to have 10Qs, which is going to be their quarterly reports that this company is going to be putting out. Now, typically, the annual reports can be hundreds of pages, sometimes 200 or 300 pages long. It's basically a book about everything about that company, some of their issues, some of their problems, some of the things that they think are really going to be good for the company. So definitely read that. It's going to be free to download, most likely a PDF version of that somewhere on their investor relations page. You're going to see this listed as Form 10K or annual report for last year. And this is going to be the most crucial part of any investment that you make, is reading this. And you can also find your news on CNBC or MarketWatch or Yahoo Finance. I probably prefer CNBC over these, but even with something like CNBC, if you're reading too much into the news, you're going to notice every other day CNBC says something differently. Like on a Friday, they might say that the stock market's going to the moon, and then the next day on Saturday, their article is about how the market's going to crash tomorrow. So they kind of flip flop because they're just they're a news company, so they want to make money. They're making money based off of clicks. So don't take that too literally either. But I do like to just check up on CNBC. Sometimes I watch it, the closing bell, and some other different things. If you have television, then you could watch some of their CNBC and just kind of get a bit better understanding of what's happening in the market so that you're at least up to date in the news. And then also investing books. I'm going to leave a lot of investing books for you to read. You can find these at your free local library. You can buy them on Amazon for $10 or $15. One of my favorites is called The Intelligent Investor by Benjamin Graham, who is viewed as the father of value investing, one of the best investors of all time. So pick up some investing books as well, because this is not something that is learned overnight. This is not something that we're going to watch a 2-hour video about investing and be expert investors with. It's going to take time. And there's two ways to really learn how to invest in the stock market. And one of them is through reading books and watching videos like this. And the other one is through experience. And I want you to remember that, because experience is something that you can't just have very quickly. It's going to take time. It takes a very long time. So mixing those two is the best way to learn. Okay, so that's how we gather information. There's other places you can gather it from too as well. Plenty of other websites as well that you can utilize to gather information. Now, let's talk about the financial statements. There are 3 major financial statements that we can use when we are looking at companies and their fundamentals. We have the balance sheet, we have the income statement, and we have the statement of cash flows, or the cash flow statement. And each one of these is going to show us a lot within the company. Peel back the layer and start to really look at the fundamentals. What is the income of this company? How much money is flowing in? How much money is flowing out? How many liabilities does this company have? Do they have a lot of debt? Do they have a lot of creditors? Are they have a lot of accounts receivable? If you had any accounting class, if you took any type of accounting class in college or even in high school, then this is going to really be a lot easier to understand. Luckily, I had a lot of accounting in college, and so I would actually suggest reading an accounting book as well so that you can get a better understanding for how these things work. But I don't think it's terribly difficult to understand these. It might look a little bit like hieroglyphics at first, but once you understand the basics of it, then you'll be able to translate that and use that information for many, many years to come. All right, so we're getting started here looking at financial ratios and metrics. Let's start off with some of the metrics that you'll see. This is actually just a screenshot from CNBC of Spirit Airlines, and this is a lot of the stuff that's underneath it that you're going to see. So we're going to dissect each one of these for the key stats, and then we'll talk about ratios and profitability. But for key stats, we want to just go over a little bit of this here. Some of it might seem obvious, others might look a little bit confusing. So we'll highlight each one of these. Now, key stats here, we have the open, we have the day high, day low, and previous close. These should be pretty self-explanatory. This is just the price. So Spirit Airlines opened at $35.51. It peaked at $37.12 at some point throughout the trading day today, which goes from 9:30 a.m. to 4 p.m. Eastern time. But different markets have different times. So if you're in California, it's going to be different. If you're over in London, it's going to be different. So make sure you research that as well. And then we have the day low. So it bottomed at $34.40 and it closed yesterday at $36.01. So that is the key stats for that. Then we have the 10-day average volume of the amount of shares that are transacted, 2.84 million. So from that, we see 10-day average volume is 2.84 million shares being transacted, and shares outstanding, we have 97.81 million shares. This helps gauge a little bit of volatility to kind of look at, how much is moving here. Is there a ton of stock being moved around? Are people buying a lot right now? Are they selling a lot right now? So it helps just kind of understand a little bit about volatility, looking at the 10-day average volume of shares being bought or sold. Now we have the 52-week high, 52-week high date, the 52-week low, and the low date for that. So this just helps us kind of understand the range of where the stock has been in the past year. We can also use the stock chart for this, so I don't really spend a lot of time looking at this, but let's look at the 52-week low. Wow, $7.25, and that was back in May of 2020 when it was really, really low because of the pandemic. So now it's gone up 5-fold or so since then, at least 4-fold. But anyway, those are just some of the basic metrics that we can use. Then we have beta. Beta is a nice little thing that we can look at, which is going to help understand a little bit about volatility of this specific stock. Now, I do have a full video showing you how to calculate beta. I think I made this back at least 4 years ago now, so it's kind of an old video. But if you want to learn how to calculate beta, it's pretty simple. What we're doing here is we are comparing the stock price, how much it's fluctuating in comparison to the overall stock market, which is going to be the S&P 500 in most cases. So we are comparing the volatility of this stock, of Spirit Airlines stock. We're comparing that with the volatility of the overall stock market, and that's going to help determine what the beta is of this stock. Now, let's simplify this and make it easy for you to understand. A beta of 1 is going to be what the stock market is in terms of volatility, of how much it goes up and down. Is it going crazy swings? Is it shooting up 50% and then dropping down 80% the next day and then shooting up 100% the next day? So those are the questions that we have with beta, and this helps us determine how volatile a stock is. So with a beta of 1.74, it means that Spirit Airlines stock moves more dramatically than something like the overall stock market. If the beta was below 1, it would move less on average than the overall stock market. So hopefully you see kind of how that can be used. A beta of 1 is average. Above 1 is going to be a little bit more volatile, maybe more choppy. Bigger swings of up or down could be either way. And a beta below 1 is going to be more stable. So, something like cash would have a beta of extremely low because it wouldn't really move at all, right? So that's how we make that determination for beta. And you can go ahead and check out that video if you really want to get into how to calculate beta, but usually you can just see it presented there for you. Now we have market cap. The market cap is going to be a simple calculation. This is market capitalization. I love looking at this because this is kind of the overall value of the company. So as a whole, Spirit Airlines is worth $3.62 billion. And how we determine the market capitalization, it's a very simple calculation. We look at the shares outstanding, the total amount of shares of stock, which is 97.81 million, and we multiply that by the stock price, which is about $35 or $36. So we take 36, multiply it by 97 million, and that's going to give us the market cap or the market capitalization of $3.62 billion. So that's how we come up with that number there. And then we also have the year-to-date change, which is going to be pretty self-explanatory as well. If you remember this from like high school math, probably it was just new minus old divided by old. It's going to give you the percent change of a stock. All right, and now we can talk about all of these different ratios and profitability. So let's get into these here. I really do suggest writing these down. We're going to give you the basic understandings of each one of these, but we could probably spend 2 to 3 hours on each one of these ratios and the benefits of it and how to use it. So we're probably not going to spend a couple hours per. We're probably just going to, focus on maybe 5 to 10 minutes on each one to give you the basics of it. And then I would highly urge you to go and do deeper research on each one of these ratios, because this is how we actually determine the well-being of a company and determining whether we're going to buy this stock. So let's start off with the first one here, which is earnings per share. It's a very basic calculation. We're just taking net income, subtract preferred dividends, and then we're looking at the common shares outstanding at the end of the period. Might sound kind of confusing, but when you actually start to look at it, it's really not terribly confusing on how to calculate earnings per share. Luckily, also, this is usually information that you can just see by Googling it or finding it within this company's information on their investor relations page on what their earnings per share is. So you don't have to do a lot of these calculations. They're already done for you. But this is going to be an indicator of this company's profitability. So how much are they earning per share? And so a higher earnings per share tends to show greater value. This isn't always the case, though. Sometimes if the earnings per share is really high, that could also be some red flags, as you'll notice with a lot of these different financial ratios. So you really want to focus on earnings per share growth. And this is something that I'm always looking at historically over the past quarters, over the past years. How has earnings per share, has it been growing? Has it been declining? This is something that you're really going to want to pay attention to very closely. Now let's talk about the price to earnings ratio, the PE ratio. It's probably, I would argue, to be the most common ratio that people talk about when they refer to stocks being undervalued or overvalued. Now, this helps gauge the valuation of a company. So a high PE ratio is going to show that there's a lot of growth anticipated for this company. And I'll give you examples of this in the next slide. We'll compare Tesla versus General Motors. Two companies that are in the same industry. They're both in the car industry, but they have very different PE ratios, price to earnings ratios. A low PE is generally seen as having lower growth anticipated. And so as you can see here, you want to find companies that have a lower PE ratio, but you think should have a higher PE ratio. Now, hopefully that makes sense there, what we're saying, because you want to find companies that don't have a ton of growth anticipated, but really there is going to be a lot of growth, right? That makes sense. So a PE ratio of 15 would mean that the current market value of the company is equal to about 15 times its annual earnings. This is a really simple calculation. You just take share price and divide it by earnings per share. So how do these two stack up here when we're looking at PE, and how can we actually use this? Let's make sense of it here. So we have Tesla stock and we have General Motors stock. Now the PE ratio here, you'll see TTM, this means trailing 12 months. And then you'll also see the forward PE, which is NTM, which is the next 12 months, a little terminology there that you might want to write down. But let's look at Tesla stock PE ratio compared to General Motors stock PE ratio. Now, the trailing 12 months PE ratio here is 1,225.99 for Tesla stock. Now, I'm going to give you a little tip here that the overall PE ratio of the average stock market tends to be roughly in the teens, sometimes in the 20s. I think right now it's in the 30s. So the average company's PE ratio is about 30 something right now. This fluctuates based off of, where the stock market is. Are we in a bull market, a bear market? But a PE ratio of 1,225 is a lot. And this doesn't mean necessarily that the company is overvalued. It just means that there is a ton of growth expected for Tesla stock. And if Tesla doesn't have that massive boom, if Tesla doesn't sell a ton of cars, if they don't have this massive growth in actual revenue and sales and profits, then it might be a problem. And I'm not saying that Tesla is a good buy or a bad buy. I'm just pointing out here that a higher PE ratio is going to show there's a lot more growth anticipated for Tesla compared to General Motors. Now, most people think of General Motors and, it's GM, right? They're not this revolutionary company right now at the moment. They don't have tons of electric cars. They don't have all these things that Tesla has. And so their growth is a lot lower in terms of anticipation. So people aren't expecting General Motors to grow a lot, and that's why their PE ratio is 13.53. So the goal here with PE ratios is to try to find those companies that have a lower PE ratio, but also you think should have a higher one. You think it should be higher because they should be able to, really perform well. So that's kind of the balance there. But overall PE ratio, it's not just one thing that you can look at and say this is undervalued or overvalued. You can't do that. It's just a basic ratio, and there's so many different ratios that we need to take into account to determine whether or not a company is undervalued or overvalued, because both of these here, Tesla and General Motors, I really can't tell you, just based off of this information that we're looking at here, I can't tell you which stock is going to perform better over a period of time because we don't have all the information yet. All right, so now we have the price earnings to growth ratio. This I like to use a lot more than just the generic PE ratio because we're also factoring in expected earnings growth into this calculation. There are some problems with this, though. One of those problems being that this is going to be dependent on what you think the earnings growth is going to be. You have to make some projections. You have to extrapolate a little bit on the data and try to make some assumptions. So that's the problem with this price earnings to growth ratio. But I do like to definitely use this. It's a pretty simple calculation. It's price divided by earnings per share, and then you're dividing all of that by earnings per share growth that you're getting. A lot of people like to target this ratio below 1, although of course, it might fluctuate dependent on the industry. If you're in tech versus if you're looking at utility companies like electric companies or coal companies or gas companies compared to, Apple and Google and Netflix, you're going to see different price earnings to growth ratios all across the board. So it really is dependent on the industry that you are looking at. But write this one down as well. Some people just call it the PEG ratio, price earnings to growth ratio is going to be a very important one to look at. And you can learn more about that if you read some books. Hopefully, we're just kind of getting the gist of this to you here. But generally speaking, yes, lower is going to be better. But if it's too low or too high, there could also be some red flags in there. Okay, let's talk about the quick ratio. This is a great way to look at the liquidity of a company. Basically, this company's ability to pay its debts, pay its bills. This is going to be extremely important. Sometimes companies, they might be, making money. They might be growing really fast, but maybe they're not able to cover all of their bills. Maybe they don't have enough cash flowing in. And so this quick ratio helps us understand their liquidity, which is basically, how much money can they come up with and for how long could they last if they cut off their revenue. And so a higher quick ratio is going to show that they have better liquidity, and a lower quick ratio is going to show that they might have a little bit more difficulty paying off their debts. But as always, what you're going to see with a lot of these different ratios, just because a higher ratio might mean that they have more liquidity, which is generally seen as a good thing, it could become a problem or a red flag when it gets too high. When you see that this quick ratio is getting really high, it might mean that this company is not using their assets properly. They're not reinvesting back into the business. Maybe they're just sitting on tons of cash. And instead of sitting on that cash, maybe they should be taking that cash and pumping it back into research and development, or maybe paying dividends or doing something with that cash besides just sitting on it. So you see with the point here where just because there's a higher quick ratio doesn't mean that it's going to be overall like a great thing. There tends to be sort of a balance there on what you want to see with a quick ratio. There's also something known as a current ratio. I didn't make a slide for it because it's pretty similar to quick ratios, but you might see that come up when you are learning more about investing and looking at these ratios that help you to look at the liquidity of a company. It's just current assets minus inventory divided by current liabilities. You can also do the current ratio, which is just current assets divided by liabilities or current liabilities. Okay, so now let's take a look at return on equity. This is going to be a very crucial thing that we're going to want to look at here. So this is measuring profitability in regards to stockholder equity. Now, return on equity is best used when comparing it to similar companies. So if you're taking the return on equity of a utility company, or you're looking at the return on equity of General Electric, and you're comparing that to Tesla, it's going to be very different. It's going to be very, very different. So make sure if you're using this, you're kind of using this in comparison to other companies that are very similar to it, because it's going to help gauge the actual health of that better versus if you're comparing it to the overall markets, or you're comparing it to comparing apples to oranges or something totally different. Make sure you're comparing apples to apples and oranges to oranges when you're doing this. Now, higher return on equity is generally a positive, but of course not always, because sometimes this can actually be from a couple of things like excessive debt. They have tons of debt. This could lead to what looks like a higher return on equity, or also sometimes profits might be inconsistent. Maybe a company's not seeing revenue for a long period of time, and then all of a sudden it all comes in at once. This could end up skewing some of this return on equity, especially for quarters, and it might end up kind of messing up some of the data. So it's not the best measurement, but it is just another one that we can add to our arsenal to understand if this is going to be a good or bad stock to invest into. And so the equation for this is just net income divided by the average shareholder's equity. Now, if you're getting confused from some of these terms, I do apologize. It is something that probably does take a long period of time to comprehend and to learn. So don't feel discouraged from this. I learned a lot of this in accounting way back in the day. So I do apologize if you feel like I'm going too fast here. But hopefully you're at least getting the basics of this. And then over time, over the next couple of weeks, you'll go more in depth and you'll learn more about exactly what average shareholders' equity actually refers to. And let's move on to the next point here, which is return on assets. Now, return on assets, it's very similar to return on equity, except in this case, you are also considering a company's debt load. This is very important, and this is why I do like it over just using return on equity. Kind of reminds me of like how you have the PE ratio, and then you have the price earnings to growth ratio. So you have those ones where it's like the PE, and then the upgraded one where you get more information. That's kind of how it reminds me of return on assets versus return on equity. You're getting more data, you're getting more information, and a little bit of a more accurate figure rather than just like a quick and dirty little number that we made with return on equity. Now, This is going to indicate profitability in relation to total assets, and it does totally differ based off of the industry that you are looking at. But this equation here is going to be net income divided by total assets. So it's a pretty simple calculation that you can make, and from that you can make determinations if you think it's high or low, especially compared to a lot of the companies in the same industry as the one that you're looking at. So what I would do is, if I'm investing into an airline stock back in the fall, which I did, I looked at each one of these different ratios. I looked at return on equity, return on assets, the quick ratio, the current ratio. I was looking at the price earnings to growth ratio. I was looking at the PE. I was looking at earnings per share, looking at all of those and seeing how they're growing or seeing if they are declining. Now, let's talk about debt to equity ratio. And I apologize if you feel like I'm hitting you with too many different ratios and terms here, but I want to lay the groundwork here so that you can really succeed with investments and be able to talk the talk when we are looking at this. Okay, so the debt to equity ratio, this is going to be indicating a company's financial leverage. Essentially, how is this company financing its operations? How are they paying their employees? Are they bringing money in? Do they have a lot of revenue flowing in? Are they able to use that revenue to pay their employees and to pay for their R&D, to pay their taxes, to pay everything else? Or are they borrowing this money? So debt to equity ratio is going to be one of my favorites for looking at the health of a company and how much debt this company is using to finance its operations. Now, there are going to be some companies that are going to have higher debt to equity ratios, but it's seen as sort of okay because they're pretty established companies. Sometimes utility companies, for example, might have higher debt to equity ratios because they've been around for a long time. They have a pretty high credit rating. They're able to borrow money at a low cost, and so they might have higher ratios. But generally speaking, higher ratios are associated with more risk. Not always a bad thing, but they are seen as having more risk. If some company, is up to their neck in debt, they have tons of debt, could be a problem, especially if maybe revenue starts to slip, revenue starts to decline, and they have interest payments they have to make. This could be a big red flag and a big problem. And a lower ratio is seen as less risk overall with debt to equity. This equation here is just total liabilities divided by total shareholders' equity. So it's a pretty simple calculation that you can make for the debt to equity ratio. All right, so now let's take a look at free cash flow. And so what we're doing here with this is we're looking at the remaining cash that's generated after accounting for the cash outflows. And this is going to be the reason why we're calculating this, or we're looking at the free cash flow, is it shows this company's ability to pay for other expenses that they might have. So for them to be able to repay their debts, maybe get on top of their debt, pay their dividends, offer higher dividends perhaps if they have more free cash flow, paying off interest, and a variety of other different expenses that might come up. So having more free cash flow can definitely be a bonus for a company. And so the way that we're going to calculate this might look a little bit confusing, but we're going to take the cash flow from operating activities, add in interest expenses, deduct tax shields on interest expenses, and then what we see here, it says CapEx, that's capital expenditures. You don't have to worry too much about that right now. Maybe perhaps you can learn more about free cash flow at a later time, because this might look a little bit confusing to you at the moment, but that's okay, because we'll learn it with time. Now, this is going to be an important one, so just make sure you write that down so you can learn more about that later. Now, let's talk about the price to book ratio. PB would be the acronym for that. So we're comparing a company's market cap to the book value of that company, and so it's a pretty basic way to calculate this is we take the market price per share and divide it by the book value per share. A book value, it's basically just going to be the net assets of the company. And from what a lot of value investors, they like to see a price to book ratio under 1, although to be honest, it's kind of difficult to find something like that today in today's market with the current valuations of a lot of companies. And, stock prices are kind of lofty now. We've been in a bull run it feels like we've been in a bull run since 2009. We had the little crash back in 2020, but for the most part, stocks are up quite a bit since then. So finding a price to book ratio under 1, if it's possible, but sometimes a lot of value investors these days, they're still okay with something in the 2 range or even 3 range. But generally generally speaking, we do like to see that on the lower end, seeing that price to book ratio. And if you wanted to calculate the book value per share, it's just total assets minus total liabilities divided by the total number of shares outstanding. So that's price to book ratio. Make sure you're writing that one down as well, at least the formula for it. Most of these ratios you can actually just find online, and you don't actually have to calculate them yourself, but it's good to have that understanding and comprehension of how to actually calculate these. Now let's talk about dividends. I see a lot of dividend investors, people who hear about dividends, they're interested in them. Let's dissect what a dividend is, how to get them, and our views on dividends offered by companies for their stock. So a dividend is a direct cash payment from a company to its shareholders, and it's almost, I view it like a cherry on top. So let's say that you are invested into Apple. Now, Apple might pay you a very small dividend, and this is usually based off of each share. They're going to give you a certain amount of money per share every quarter, or sometimes every year, sometimes monthly. It really depends on when this dividend payout structure is. But they're going to give you a very little bit of money for every share that you own of that stock. And it's almost like a reward. It's like a thank you. And it's a way of the company taking the money that they're making, and when they have the money that they've made at the end of the quarter, at the end of the year, they make decisions and they say, what should we do with the profit? Should we reinvest this profit? Should we put it back into research? Or should we pay it out as a dividend to our shareholders? And so some companies choose to pay out dividends to their shareholders. There are pros and cons to this. The good thing about this, if a company is paying you a dividend, sometimes this can be 2 or 3 or 4%. We've seen dividends of 10% per year on a stock, which sounds really nice. But there are pros and cons to this. So the good thing is, yeah, sure, you can get some money. You can get this cherry on top, some cash payments or dividend reinvestment from these stocks, from these companies. A lot of older companies like Coca-Cola or Pepsi might pay dividends that average about 3 to 4%. But the downside to this is that a company is looking at its money, it's looking at the money that's making, and it's deciding that instead of reinvesting this back into the company, it's best suited to just pay people dividends and pay them little bits of money. So I'm kind of conflicted on this. And I have to be honest, investing for dividends strictly, I don't know if it's a great move financially over a long period of time, because it could end up hurting a company's growth. If they never reinvest back into their business and they're only paying out their dividends, they're giving away all their profit to their shareholders all the time, it could be somewhat problematic. So you see where that kind of goes in hand there. And that's why it's good and bad. I would simply view these cash payment dividends as a little cherry on top, a little bonus if you can get it. But I want to warn you against a couple of different potential issues. And one of them is called a dividend trap. And so this is the next slide here, where we talk about common stock market traps. Now, a dividend trap was, I think, the first real major trap that I fell into when I first started investing. And this is why I like to think that it's smart to start very slowly in the stock market. Because if you jump into the stock market too quickly, you take your life savings, you dump it into something, you might fall into one of these common stock market traps. There's a lot more that we could have added to this list, but I only included a couple here today in this video. But one of them, and the first one that I fell into, was a dividend trap, where I was looking at a dividend of stocks, and I would find stocks that had dividends that were paying 10% or 15% yields annually. And the problem here is that they were unsustainable dividends. The dividend was too high for the stock to be able to pay out, and it was unsustainable. So that was one of the first stock market traps that I fell into. If you see a stock that has a dividend that looks really, really high, I would be careful. I would be a little bit worried about that because it's probably really high for a reason. It could be a dividend trap. So I like to pick stocks if I'm investing into a stock and the dividend is more than 6 or 7% annually, that's going to be a big red flag for me. And I'm going to say, what's the reason for this? Why is the company not cutting their dividend? They should be saving money, and that could be a lot of money that they're paying out unless they're growing very quickly. It would just be very confusing and a lot of red flags if the dividend is too high. So don't fall into that trap. Those were the first few companies I invested into. Some of them worked out. A lot of them went bankrupt because I didn't know what I was doing. Also, common stock trap here is relying simply on the stock price history I'll give you a great example of this. Look at any of the cruise lines like Carnival Cruises or Caribbean Cruise or Royal Caribbean or Norwegian Cruise Lines. These cruises, if you're simply just looking at their stock price and making a judge off of, okay, let's say that the stock price is at $80 right now, but before the pandemic last year, the stock price was at $120, and you're looking at it saying, well, it's still below what it was previously, and I think it's going to come back up. Don't do that, because if you're just looking at the stock price, you're missing certain things. Like maybe the company has issued more shares of that stock that can dilute the stock and make your stock not worth as much. Or perhaps companies are raising corporate debt and it could not, be reflected in the stock price. I don't remember which company it was, but one of the cruise lines, I think most of the cruise lines, to be honest, were raising money, bonds. They were issuing bonds at coupon rates of like 15%. So they have interest rates of like 15% that they're paying, and they did all of this, and it might not be necessarily reflected in their stock price. So just because a stock price is lower than what it was previously doesn't mean that it's actually going to be a better deal overall. So just please don't put too much thought into just looking at that stock price chart if you're looking at the charts. Also, a common trap here, cognitive bias, right? If everybody else around you is saying, yeah, invest into the stock, that is a very, very common trap that we see. Look at Tesla. Hey, I have Tesla stock, but if you're looking around, everybody's saying, yeah, Tesla's going to the moon. Tesla's going to be the next, $1 trillion company. It's going to be a massive company. But look, if you're looking at a company like Tesla, you have to realize there's going to be risks involved with everything. And so there's cognitive bias here where people might think that, yeah, Tesla's going to be a 10 or $20 trillion company. But you have to ask about certain scenarios that might happen. Like what if, God forbid, what if Elon Musk, something happens to him and he's not the CEO of Tesla anymore? Suddenly that price of the stock is going to come down very, very quickly because Elon Musk is kind of the face of Tesla. And so you see kind of these things that we have with cognitive bias, but also going too heavy potentially into one specific stock. Be careful with that. I like to diversify. If you have your life savings in one company, let's say you're an Enron employee in the 90s. If you're familiar with Enron, then you'll know that they went bankrupt and they had a lot of problems and a massive scandal. If you were an Enron employee or you were just so bullish on Enron, that's all the stock that you had was in that one company, and the company goes belly up. I mean, imagine if you had your life savings in Lehman Brothers or Bear Stearns back in the last financial crisis. Or let's say that you had your life savings in Papa John's Pizza back in 2017, and then there's a big scandal, right? So stuff happens. Make sure that you are diversified at least to some level. In terms of individual stocks, I like to hold anywhere between 10 and 20 individual stocks. Not too many, because then it's going to be difficult for me to keep track of all of them, but not too few to the point where I'm not able to sleep at night, because I know that if one company gets caught with their pants down or they end up having some big issues, I could end up having some big issues myself. So finding that right level of diversification. And then also another trap here is, hey, make sure you are looking at this company's competitive advantage or their moat. What does this company have that's very difficult for other companies to mimic, to imitate, to copy? And if they have a moat, this is definitely going to be a benefit for you and for investing into that company. If they have patents, if they have trademarks, if they have certain intellectual property or physical property that's worth a lot of money, that's going to be difficult for other companies to copy, then this can definitely be good. Look at something like Walmart, for example. What's the competitive advantage or the moat for Walmart? Well, they actually have quite a bit. One is that they're really well established already, but they're able to keep their prices so low because they have so many people buying. And so they have a lot of competitive advantages and moats all around the board. Let's look at Tesla, because we've been talking about them so much. What's the moat that Tesla has? Well, sure, they're really far ahead with their car and the technology, but also they have superchargers all over the country. No other other car manufacturer, Ford, General Motors, Toyota, they don't have the amount of charging stations that Tesla has. And this is a serious moat. And this is one of the reasons why they are so much further ahead than any other car company in the electric space. I mean, you have Tesla superchargers in almost every part of the country, especially on some of the big roads like Route 80 or Route 70. And a lot of the big roads have those chargers all over the place. That's a great moat that Tesla has, and it's extremely difficult for other companies to catch up with something like that. So pay attention to those moats and those competitive advantages that makes it difficult for other companies to compete. Now, let's talk about how much should you invest. This is obviously not a question that I can answer for you. I can't tell you that you should take, 82% of your money and put it into the stock market. And I can't tell you what to invest into, of course. But the question of how much should you invest, here's what I would suggest. I would suggest starting with something that you are willing to lose, that you can part with, and that you can say confidently that you don't need this money, especially not in the short run, because the stock market can fluctuate a lot. And if you are trying to invest and you're trying to quadruple your money by next week because you have to pay your rent, don't do it. Just forget all the stuff that you watched here, because if you're trying to put your money into a slot machine basically in the markets and trying to 10x your money very quickly, this is probably not the best move to make. But how much should you invest? Start with something that you can afford to lose. I started with $50. If that sounds good to you, then I would start with something like that as well. Because like I said earlier, there's two ways to learn. One, through information like this, watching things, reading books, but also through experience. And it's really hard to put a price tag on experience. It takes time. You're going to mess up. You're going to have bad investments. You're going to have some good ones, hopefully, but you're going to have bad investments. You're going to have slip-ups. You're going to make mistakes. I made so many mistakes, especially in the first few years. I am so happy that I didn't have a lot of money when I started, because if I did, I would have lost a lot of money. So start small. Start with $50. Start with $100, maybe $1,000. I don't know what financial position you're in, but please, if you're sitting on a large amount of money, go consult with a financial advisor. They can help you a lot more than just me, a random guy on YouTube. But consult with a financial advisor if you are sitting on a lot of money, or start really small. Start with a very small percentage of your money and maybe start doing it every month, very slowly, learning more as you go, and then you build that skill over time. That's how much you should invest. I can't tell you specifically, but I would start with under $1,000. All right, now real quick, let's talk about bull market versus bear market. What's the difference between these two? The way that I learned this, it's kind of a stupid little way to learn, but a bull market, I view this as a bull. It's charging forward, it's going upward. So a bull market is when the stock market is growing over a multiple quarters. It's growing over a period of time. And then a bear market, this is, like I said, kind of a foolish, stupid little way that I learned this, but I was told that it's kind of, if you imagine like a bear coming down and attacking somebody, that's a bear market. A bear market is going down, a bull market is going up. And so if we have multiple quarters where the markets are going lower and lower, that would end up being a bear market. I would suggest learning about the multiple bear markets and bull markets over the past 100 years. And you can read about what caused each one of those. Sometimes it can be a very intricate situation. Sometimes it can be interest rates that are rising too quickly. Sometimes it can be that there are massive banking problems, like what we saw in 2008, right? With a lot of the banks almost failed, and the governments had to bail out the banks all around the world because the banks were over leveraged. The banks were getting greedy and they were making some really bad decisions. So that was the cause of the last financial crisis, the one that we had here with the pandemic. What caused that quick little bear market? What happened there, right? So each one of these, you're going to be able to, look at bull markets, bear markets, and get a better understanding for what has caused those. We have been in a bull market from, I think it was really like 2009 until 2020, which I believe might have been the longest bull run in history. If not, then it was the second largest bull run in history. They usually don't last that long. It's very difficult to predict when a bull market or a bear market is going to happen. But obviously, most investors would want to be in a bull market unless you are doing short selling, which maybe you'd want a bear market at that point, which we'll talk about short selling in just a second here. Let's talk about market order types. These are the different types of orders that you can have. I do have a video on this as well, so I will link to that video if you want to see a full video talking about these market order types. The first order is it's called a market order. So if I want to buy a stock, I can say I want to buy 100 shares of this stock at whatever the current price is at the moment. And the price can fluctuate a lot. It depends on who's selling and how much they're selling. So this is bidding. This is like you're going into a market and you're trying to buy something. You're kind of fighting other people to buy it as well. And so the price can fluctuate a lot. You're putting in a market order for X amount of shares, and you say, I don't care what the price is. I'm just buying it at whatever the current market price is today. That's a market order. It's the most common. I would argue probably 70% of orders placed in the stock market are probably market orders. Then we have limit orders. So this can be maybe perhaps if you want to buy or sell something at a certain point, say that you want to buy a stock once it hits a certain price point, once it hits $10, then you can do that by placing a limit order. And you can also do that on the flip side as well. Maybe you want to sell a stock when it hits a certain point. You can do that with limit orders. Stop orders, very similar, but on the flip side. I recommend just watching the video that I made about it if you want to learn about those, because it's kind of difficult to explain just here with a blank slide. I probably should have made a couple more slides for this. And then there's also stop loss orders and trailing stop loss orders. So for example, if you wanted to set a trailing stop loss order, it can just follow your stock. Let's say your stock price is going up and up and up, and you have a stop loss order, trailing stop loss order following it. And then if it ever dips below a certain price point, it can automatically execute that trade without you having to be there. So you could be, taking a poop or something, or you could be picking your nose, and suddenly it gets triggered with one of these stop loss orders or a stop order or a limit order. It can get triggered at any given moment when that stock price hits the certain point that you set within your brokerage account, and then it can be executed without you even having to be there. You could be out in the woods somewhere without any Wi-Fi, and this could execute. The reason why I like to use things like stop loss orders is for that very reason. If I am camping, sometimes I might be off the grid for a week, and I don't want to have to worry about some of my stocks going to zero. And so I will set trailing stop loss orders or stop orders in general so that my stocks can automatically sell in case they start to drop too quickly. They can sell, and I don't have to worry too much about losing all of my money. So that's the reason why we use some of those different market order types. Once again, you can go check out that video that I will link down below if you want to learn more about market order types. Now, let's look at short selling, explain this a little bit. We've had a lot of questions about short selling. I also have a video about this that I will link in the description below that will give a better explanation. It's like a 10-minute video probably that goes over this. But here's the 4 basic steps of short selling. Maybe you heard about GameStop, right? The short squeeze, the big short squeeze that happened back in January of 2021. Short selling, you're basically betting against a stock. You think that a stock is going to go down. And so if you think a stock's going to go up, yeah, sure, you can buy the stock. You can buy the shares of the stock. But if you think it's going to go down, how do you make money on that? There's always a way, and it's called short selling. So it can be pretty dangerous. It can be pretty risky. So you probably shouldn't do it right away. But I've done it a number of times, and it's worked out sometimes. It's not worked out sometimes. Step number 1, you're going to borrow shares of a stock. So let's say that I think Walmart stock is going to go down. I think it's going to go down. I think maybe Amazon is going to beat them or whatever. Target's going to take over. Who knows? Let's say that I think Walmart stock is going to go down. So what I can do, I can borrow shares of Walmart stock from somebody. Let's say I borrow 100 shares of Walmart stock from my friend. And I then take those 100 shares that I just borrowed from him and I sell those shares. Okay? So I borrow shares. I then sell those shares. I don't own them. This sounds really weird, right? You'll see how this all comes together. I borrow these shares of stock. I then go and sell these shares. Then I wait for the stock price to drop. I then buy those shares at a later date, hopefully at a lower price. And then I return those shares to the person that I just borrowed them from. I really do hope that makes sense. That's the simplified version of how short selling works. But read over these 4 steps really quick, right? I'm borrowing shares of a stock. I'm then going and selling those shares to somebody else. Then I'm buying those shares back at a lower price and then giving those shares back to the person that I borrowed them from in the first place. And when I give those shares back to the person that I just borrowed them from, it could be a week, it could be a month, depends how long, I'm going to give them a little bit of interest on top so that they can, that's the reason why they lent me their shares in the first place. So that's how short selling works. That's a very simplified version of how it works, but hopefully that does help you understand the functions of it. And you can do this most likely within your brokerage accounts. I know most brokerage accounts allow you to do short selling. You want to be careful with something called naked short selling, people can end up getting in a short squeeze where you can end up losing a lot of money. That's what happened with Melvin Capital, with GameStop, massive craze. You should read the Wikipedia on that because it was an absolute insanity for the weeks in January of 2021. I barely slept. So that was pretty fun. But that's short selling. Now, let's quickly talk about investment taxes. You're going to have two main types of tax in America. Keep in mind, this is for the United States, and also, of course, I'm not an accountant, I'm not a CPA, so please consult with your tax advisor. I'm not a tax advisor. I think I just have to say that. So we have short-term investments. If you are holding your stock for less than a year and you sell it, you might be subject to these rates here. So you can see anywhere between 10% and 37% that you might be taxed at on a federal level. You'll probably have state tax, you might have local tax, and this is, of course, for America. If you're in Europe, I don't know what your tax brackets are going to look like. Might be higher, might be lower. This is for short-term investments. If you are investing for less than a year, so if you buy a stock and you sell it after a month or after a day or after 3 months, that's a short-term investment. You're taxed at your regular tax rate, whatever you're paying for any other type of income that you might be making. Then we have long-term investment. This is known as long-term capital gains tax. And this was something that I believe was really kind of implemented back, I think, right around the dot-com bubble, which is one of the reasons why the dot-com bubble also happened with a lot of VC money flowing in. That's getting off topic here. Let's talk about long-term investments. If you're holding stocks or assets for longer than a year, then you might end up getting taxed at these rates. 0% if your income is $0 to $40,000. That's pretty nice. 15% if you're in between $40,000 and $441,450, and then 20% long-term capital gains tax on anything over $441,451 or more. You're going to be taxed at that 20% rate. This is once again at the federal level. You're probably going to have state tax. I know Pennsylvania throws on an extra 3.07%. Then I might have some local tax on top of that. If you're in California, you might end up paying an extra 13.3%. So these are the tax rates. I love tax law. I would suggest reading some books about taxes. It's fun. Maybe I'm weird. I don't know if you like taxes too, but if you do, join my tax club. I don't have one, but it'd be fun to start. Okay, now let's talk about some of the best investing books. So I have a couple here. I've actually given away most of my books in general because I like to adapt sort of a minimalist lifestyle. So I used to have dozens and dozens of investing books. One of the best, though, that I would definitely suggest reading is called The Intelligent Investor. It's really great for fundamental analysis. It's great for value investing if you're kind of a Warren Buffett type of person. It was written by Benjamin Graham, who was the mentor to Warren Buffett, who I think is one of the richest people in the world. For many years, he was the richest person in the world. Probably has close to $100 billion right now, and he gives a lot of it away too. But he just keeps making more. It's kind of crazy. This is a great book. Read The Intelligent Investor. Highly recommend that you need to read this. You could also read another book called Security Analysis. This one is more so kind of like a textbook. It's going to feel really dry to people who don't like reading in the first place. So I don't know if I'd recommend that to people who don't like reading. But if you're a bookworm, like I personally enjoy reading textbooks, and this one has more of a textbook feel to it, a little bit more dry, and it's a massive book. I don't have it with me, but it's like massive, huge, and I think it's a little bit more expensive too. You might pay close to $60 for Security Analysis, but I would recommend that one as well. But then honestly, I love these For Dummies books. These are great books. People trash talk For Dummies books all the time. I don't know why. I love these whenever I'm getting into a topic. This big one right here, Investing for Dummies. If you read this cover to cover, you are going to be so well positioned for investing and just in general to understand the terminology, to understand, it has all the different financial ratios in here. So this is a basic For Dummies book. It was $29.99 US dollar. So not bad. I wouldn't be ashamed to read something like this. And then they have, different versions like technical analysis if you want to get really deep into that. They have one for fundamental analysis. I would recommend those as well. Some of my other favorite books, though, for investing, I would say is A Random Walk Down Wall Street. This was written by Burt Malkiel, who's a really, really amazing economist. And he essentially presents in this book that the markets are almost random and that a monkey could throw darts at a dartboard and perform just as well with stocks as a person who spent 30 years in the markets. So that's his consensus, and he really kind of drives that point across. Very interesting read. I would suggest reading A Random Walk Down Wall Street, but also I would suggest reading a book called One Up on Wall Street, which is another great book that I think everybody should read. And you can get more technical. I would really personally suggest reading some books like accounting books, for example, so you can understand the financial statements a lot better. But those are some of my suggestions for some of the best books that you can read. All right, so we've gone through quite a few things in this video. I really hope that you have gained quite a bit of value from this and you've learned something new here today. But let's talk about the next steps going forward. Let's give you a quick little plan of what I would personally suggest doing if you want to start investing into the stock market. And I would start off by starting with a very, very small amount of money, something that you're willing to lose, $100, $200, $300, whatever you can afford, but something relatively small. Because the truth is, you might end up losing it. You might make a lot of money, but you might lose it as well. So start with a small amount of money, and then every month, I would suggest reading one book per month. Pick something from a big list. You can just Google best investing books, and you'll find some great ones, or send me a message on Instagram. I'll try to get back to you and respond with some of my favorite books. It gets a little bit difficult with just, more views and everything, so understand if I can't respond to you. But pick one book per month, read that book, and after 6 months of getting your feet wet, maybe putting in a couple $100 per month into the stock market, combined with gaining so much knowledge from reading free books at your local library, I really think that you can be set up for success. This, of course, is not a promise. This is not a guarantee. I've seen people lose money in the stock market. Please don't treat it as a casino. It's something that you can make money with, but you need to be really diligent about how you're doing it and use logic rather than emotions. So I will leave some of those links down below to the resources as well as some of the stockbrokers that I would suggest using. Keep in mind, some of these are affiliate links, so it means I might get a small amount of money or commission for you signing up for some of these brokerage companies. This just helps keep my videos free, so you don't have to click on those links, but if you are going to sign up for one of those accounts, I really would appreciate it if you would use one of those links if you found some value in this video. So thanks for watching. I really do wish you the best. Go ahead, follow me on Instagram if you want to keep up with what we're doing. Make sure you subscribe to the YouTube channel here for more videos, and I will see everybody in next week's video.